What I'm about to show you is something banks in America hope you never find out. Imagine you're drowning in credit card debt, and suddenly you send just one envelope. And the moment the bank opens it, they panic. Why? Because inside is a simple document that forces them to show the truth behind your debt. And once you have it in your hands, you can slash thousands of dollars off what you owe, sometimes cutting your balance by 80, even 90%. Sounds unbelievable, right? But stay with me, because this could be the exact tool you need to finally break free from endless interest and harassing collection calls. And what I'm going to reveal next will shock you even more, because it explains why your $5,000 debt can suddenly turn into $20,000 or more. You see, the reason your debt explodes so fast in the United States is simple: interest on top of interest. It's what they call compound interest, and it's designed to trap you. Let's say you borrowed $5,000 on a credit card. If you only pay the minimum, that balance can quietly grow into 15 or 20,000 over time, even if you never swipe that card again. And if you fall behind, late fees and penalty APRs kick in, sometimes doubling the rate you originally agreed to. That's how a simple purchase can snowball into a financial nightmare that feels impossible to escape. But here's the catch: banks don't want you to realize that you actually have the right to demand every detail of how that debt grew, step by step, line by line. And once you force them to show their math, you'll understand why they get scared, because what you discover in that paperwork can completely change the negotiation in your favor. And the part I'll explain next will open your eyes even more, because it shows how one simple request can put the bank on the defensive instead of you. Most people in the United States don't even know this exists, but under the Fair Debt Collection Practices Act, you actually have the right to ask your creditor or the collection agency for something called a debt validation. This is like demanding the receipts, the proof of every dollar they say you owe. And once you make that request in writing, they are legally required to stop all collection activity until they provide the full documentation. Think about that for a second. The phone calls stop. The letters stop. Even the threats stop, because by law they cannot pursue the debt unless they show you the complete breakdown. And here is where it gets interesting, because when you receive that debt validation report, it works almost like an X-ray of your debt. It shows the original amount you borrowed, every interest charge, every late fee, every penalty, every payment you ever made, and how they calculated the balance that they now claim you owe. When you finally see it in black and white, it can be shocking. You realize how unfair and inflated the numbers really are, how a $2,000 balance somehow grew into $12,000 or more, and sometimes you even catch mistakes like fees that were never authorized or charges that simply shouldn't be there. The truth is, banks and collectors count on you never asking for this document, because once you hold it in your hands, the power shifts. Suddenly you're no longer begging for mercy. You're pointing at their own paperwork and saying, "This is wrong, and I know my rights." That is the moment they know they can't play games with you anymore. And what I'm about to explain in the next part is the exact strategy you can use with this document to slash your debt down to a fraction of what they claim you owe. And once you understand it, you will never look at a collection notice the same way again. Now, let's get even more practical, because knowing your rights is only the first step. The real power comes when you put those rights into action. Imagine you send a simple debt validation request, and the collector answers with a giant stack of numbers, dates, and calculations. At first it might look overwhelming, but when you start reading, you notice something strange. Maybe they charged you interest on a balance that was already paid, or they applied late fees on top of other late fees, or they added an insurance or service charge that you never agreed to. These small details can completely change the amount they say you owe. And here is the secret that hardly anyone talks about in the United States. If the paperwork is incomplete, or if they cannot prove every step of how the debt grew, they cannot legally enforce the full amount. That means you have leverage, and leverage is the one thing banks hate. With it, you can turn a conversation that usually feels one-sided into a negotiation where you are in control. You can say you are willing to settle, but only based on the original principle, not the inflated number they are trying to push. Many people do not realize that collectors often buy debts for pennies on the dollar. They might purchase a $10,000 debt for less than $1,000. So when you show them you understand the real math and that you can challenge them if needed, they prefer to accept a reduced settlement instead of risking a complete loss. This is why some people end up paying just 20 or 30% of the balance and walking away debt-free. But you cannot get to that point without the document, because without it you are just guessing and begging, and that is exactly what they want. The banks and collectors want you confused, embarrassed, and desperate, because that is when you sign anything they put in front of you. Once you flip the game and start using their own paperwork against them, the fear shifts to their side, and in the next part 1 I'm going to show you how to actually use this fear to negotiate massive discounts that most people think are impossible. At this point, you can probably see how powerful this strategy really is, but most people in America never take advantage of it simply because nobody tells them it exists. The banks and collectors are not going to volunteer this information. They want you to stay in the dark. That is why people keep making payments for years without realizing they are mostly paying interest and barely touching the principal. But when you demand the breakdown and study it carefully, you finally see the truth, and once you see it, you cannot unsee it. You realize the system is designed to keep you paying forever, but you also realize there is a legal way out. And before I reveal the exact steps to push for the biggest discounts, let me ask you something. If this kind of content is helping you, subscribe to the channel right now. Here we talk about what nobody else dares to explain, using real examples and clear language so you can protect yourself and your family. Subscribing makes sure you do not miss the next strategies, because what I am going to reveal now is even stronger. In the next part 1, we'll show you how one simple move can instantly cut the conversation with a collector in half and force them to offer a settlement you never thought possible. When you reach this stage, you start to realize that the debt validation process is not just paperwork, it is a weapon. Once the collector sees that you know how to use it, the tone of the conversation changes immediately. They stop talking down to you and start offering deals, sometimes even without you asking, because they know if they push too hard, you can challenge the entire balance. This is the moment where you stop being the weak side and start being the negotiator, and that feeling of control is something most people in debt have never experienced. It is not about magic tricks, it is about using the law and the numbers that they themselves are forced to provide. That is why I want to know who is watching this right now. Write your first name and the city or state where you are watching from in the comments, because I want to see how many people across the country are finally learning the truth about their rights. Your story might inspire someone else who is going through the same nightmare, and together we create a community of people who refuse to be taken advantage of by the system. And stay with me, because what I am going to explain next is the real turning point where you discover the one piece of information hidden inside that document that can instantly destroy the bank's argument and put you in the driver's seat of the negotiation. This is the part most people never hear about, and it is the reason banks and collectors hate when you request a validation. Hidden inside that breakdown is the separation between the original principal you borrowed and all the interest, fees, and penalties they stacked on top of it. Once you see that number clearly, you understand something powerful. The law does not force you to pay endless interest forever, but it does recognize that you owe the original principal. That means you now have a strong argument to settle by paying only the true amount you borrowed, not the inflated balance they wave in your face. Imagine discovering that your supposed $10,000 debt is really just $2,000 in principal. You walk into a negotiation not as a desperate debtor, but as someone demanding fairness, and many times the collector agrees to close the account for the principal alone or even less. This is the bombshell moment, the turning point where the fear shifts completely to their side. They know that if you challenge the extra charges, they might have to erase them, and they would rather recover something than risk losing everything in court. That is why so many people who use this strategy end up settling for pennies on the dollar and finally walking away free. And what I will reveal next is how to prepare and deliver your request step by step so that the bank or collection agency has no choice but to respond. And this part is where you go from knowing your rights to actually using them in practice. So let us get into the practical steps, because knowing the law means nothing if you do not put it into action. The first thing you need to do is prepare what is called a debt validation letter. It does not have to be complicated or full of legal terms. It simply needs to state that under the Fair Debt Collection Practices Act, you are requesting full validation of the debt they are trying to collect. You write down your name, address, account number if you have it, and clearly ask them to provide the original contract, the breakdown of every charge, the calculation of interest, and proof that they have the legal right to collect this debt. This letter must be sent by certified mail with return receipt so you can prove that they received it, because once they receive it, the clock starts ticking. By law, they must stop all collection efforts until they provide the validation, and if they do not provide it within 30 days, they lose the right to continue pressuring you. Just think about how powerful that is. With one letter, you can freeze the calls, the threats, even the risk of being sued, while forcing them to put everything in writing. And here is the part that most people never realize. If they cannot provide full documentation or if they fail to respond in time, that debt may become uncollectible, which means they cannot legally pursue it against you. That is how strong this tool really is, and in the next part 1, I'm going to show you exactly how to analyze the response they send you so you know whether it is valid or if they are trying to trick you with incomplete paperwork. When the response finally arrives, this is where you need to pay close attention because not every validation is complete, and many times collectors try to overwhelm you with paperwork that looks official but is missing key details. Start by checking the basics: the original creditor, the account number, the amount of the original loan or balance, and the exact breakdown of charges. If any of these are missing, the validation is not valid. Then look for extra charges that were never part of the original agreement, such as insurance add-ons, administrative fees, or unexplained penalties. Many times they sneak these in because they assume you will not notice, but once you call them out, they lose the ability to enforce them. Another red flag is when the numbers do not add up, like a balance that keeps increasing even after you made payments or interest rates that are higher than what your contract allowed. These mistakes are more common than you think, and they give you even more leverage in negotiations. Remember, collectors buy debts in bulk, and often the records are incomplete or sloppy, which means they might not be able to prove every step of the balance they are claiming. That is why analyzing the validation carefully is the difference between paying thousands more than you should or cutting your debt down to a fraction. And what I will explain in the next part is how to take this analysis and turn it into a negotiation strategy that forces the collector to the table on your terms instead of theirs. Now comes the part that really changes the game, because once you have identified mistakes or inflated charges, you can use them as your bargaining chip. Instead of going into a negotiation feeling weak, you now sit at the table with proof in your hands. You can say the original balance was $2,000, but the paperwork shows they added $10,000 in fees and interest that are not justified, so your offer is to settle for the original balance only. Collectors hate this position because they know if you take it to court, a judge will likely side with you when the paperwork does not hold up. That is why they often prefer to accept a reduced settlement quickly rather than risk losing everything. The key here is confidence. You are not begging, you are stating facts backed by their own documents. And here is something most people do not realize. You do not have to pay the amount in one lump sum if you cannot. You can often negotiate a structured settlement based on the corrected balance. The important thing is that the inflated charges are off the table and you have regained control. Every negotiation you enter with this strategy puts the bank or collector on defense, and every time they agree to reduce the debt, it proves that knowledge is power. And what I am going to show you next is how to document the agreement correctly so that once you settle, they cannot come back later and try to collect more from you. Once you reach a settlement, it is absolutely critical to document everything in writing because a verbal promise from a collector means nothing in the United States. Before you send a single dollar, you need a written agreement that clearly states the amount you will pay and that the payment will be considered payment in full for the account. This is usually called a pay for delete or settlement agreement, and it must include the account number, the agreed balance, the deadline for payment, and most importantly, confirmation that the debt will be reported to the credit bureaus as settled or deleted. Without this document, you run the risk of making a payment and still being chased for the rest later, or worse, the collector taking your money and selling the balance to another agency. That is why you never rush. You demand the written terms and you keep a copy of everything, including the envelope you mailed it in and the proof of delivery. This paper trail is your protection if they ever try to come after you again. And once the payment is made, you also want to check your credit reports through Equifax, Experian, and TransUnion to make sure the account is updated or removed as agreed. If it is not, you can dispute it directly with the bureaus using the settlement letter as evidence. This step is what seals the deal and makes sure you are truly free from that debt forever. And in the next part 1, I'm going to explain how this process not only clears your debt, but also rebuilds your credit score so you can qualify for new opportunities instead of being trapped in bad credit for years. Once the debt is finally settled and reported correctly on your credit file, you have the chance to start rebuilding your score, and this is where most people miss out. They think paying off the debt is the end of the story, but in reality, it is just the beginning. The first thing you should do is pull your free annual credit reports from Equifax, Experian, and TransUnion to confirm the account shows as settled or deleted. If it does not, you immediately file a dispute with the Bureau attaching your settlement letter, because by law they have 30 days to correct the record. Once the negative account is updated or removed, your score begins to climb. But you should not stop there. You can add positive history by opening a secured credit card or using a credit builder loan, keeping your balances very low and paying every bill on time. Even a small utility or phone bill paid consistently can help rebuild trust in your profile. Over time, these positive marks outweigh the old negatives, and within a year or two, your score can improve enough to qualify for better rates on car loans, mortgages, or new credit cards. This is the part banks do not want you to know, because they prefer you to stay stuck with bad credit forever, paying higher interest for everything. But when you combine debt validation, smart negotiation, and strategic rebuilding, you create a path to financial freedom that is not taught in schools and rarely explained by professionals. And in the next part 1, I'm going to show you the common traps people fall into after settling a debt, mistakes that can undo all of this progress if you are not careful. One of the biggest mistakes people make after finally settling a debt is thinking they are completely safe and letting their guard down. But the truth is there are traps waiting if you do not pay attention. Sometimes a collector will accept your payment and still sell the leftover balance to another agency, and a few months later you start receiving new calls about a debt you thought was gone. That is why keeping your settlement letter and proof of payment is critical, because it is your defense if this happens. Another mistake is closing every credit account you had in the past. It feels like a fresh start, but it can actually hurt your score because the length of your credit history is an important factor. If you close your oldest account, you might lose years of positive history. A third mistake is rushing back into borrowing too quickly. After feeling the relief of settling, some people jump right back into using credit cards carelessly and end up in the same cycle again. The real goal is not just to escape one debt, but to build habits that keep you out of debt permanently. Pay on time, keep balances low, check your credit reports regularly, and question anything that looks suspicious. Remember, banks make billions from people repeating the same mistakes, and the only way to beat them is to stay alert even after you win a negotiation. And in the final part 1, I'm going to show you how to put everything together, the mindset and the steps, so you can protect yourself for life and never fall back into the trap of endless debt again. Now you have seen the full picture, from understanding how debts grow out of control to using the law to force banks and collectors to reveal the truth, from negotiating with confidence to rebuilding your credit and avoiding the traps that keep people stuck for life. This process is not about tricks or shortcuts, it is about knowledge and courage. When you know your rights and you take action, the balance of power shifts and the fear that once controlled you now sits on the side of the banks. You do not have to accept endless interest, harassment, or shame. You can stand up with proof in your hands and demand fairness. That is the real secret inside the envelope, not magic, but the power of information that most people never use. If you still have questions, leave them in the comments below, and I will personally answer you, because no one deserves to feel helpless in front of a collector. Share your experience, your victories, and even your struggles, because when we speak out loud, we break the silence that the system depends on. Take these steps, protect yourself, and remember that financial freedom is not a dream. It is a right that starts the moment you decide to fight back.